first time tonight, I think I'm going to try to explain this in a way where you don't need to necessarily have heard last week's presentation. But this topic of budgeting is just so crucial. I think it's something that most people struggle with. As a financial advisor, I can say that the main reason that people kind of come to me is because they don't feel like they have a sound grasp of how to budget well, how to save well, and so on. So I think for you guys, having a foundation of this topic before you pursue your careers and things like that, it's going such an advantage because, as I mentioned last time, for a lot of people that I present this topic to, they have their mortgages, they have their car payments. It's too hard for them to backtrack once you've gotten yourself into certain spending obligations. So when so much of that is in front of you and you're equipped with this knowledge, it's going to be a huge advantage for you guys. So I'm going to pause kind of throughout, give us time for questions. I'll stop at the end for questions. But it is really important and a little bit more technical than last week. So certainly ask any questions you have as we go. What I'm going to focus on today is going to be needs versus wants. I'm going to spend the vast majority of the presentation really going into detail on a specific budgeting strategy that's called the 50-20-30 strategy. So just like dieting, there's a million different kind of approaches to something like managing your budget well. I'm a big subscriber to this one, so I want to make sure that we really focus on this and you guys know it well. We'll talk about the benefits of automating your savings and the advantages of a bank. And then next week, we're going to hit on the last topic in our 3-week series, which is going to be investing. So whereas today we're going to kind of focus on making sure that we're doing things appropriately to make sure we're ultimately saving well, next week's topic on investing is going to make sure that you're equipped with the knowledge to take those savings and eke out some growth from it so that it's working for you. So let's kind of start by talking about needs versus wants. This is something where I think what people who are good at managing their money all have in common is that they all have a really, really good understanding of what needs are versus what their wants are. And while this sounds really obvious, in practice, it's really not that easy to do. A lot of people really struggle with this. I'll give you a good example. In today's world, we all kind of need phones. I think we can agree on that. However, there's a big difference between needing a phone so that we can get a hold of our clients, get a hold of our loved ones, and needing an iPhone or a fancy smartphone that has unlimited data. And that might be fine. That doesn't mean that that's poor budgeting, but I'm just using that as an example of where, understanding needs versus wants is really, really important to be able to manage our money well. I'll also say on this topic that, a lot of what we're going to talk about, it's going to be X's and O's. It's going to be rules of thumb. It's going to be strategy. But there is a big element to being good at managing your money that has to do with understanding human nature. And part of human nature is to never want to go backwards in life, never want to feel like you're taking a step back. And what that means for us as spenders and as consumers is that when we buy our next car, we're usually buying a newer version of what we have, or we're buying a nicer version. When we're buying a house, we're usually buying a bigger house or a nicer house because we never really want to feel like we're taking a step backwards. And so I think if you really grasp what's my needs, what's my wants, you're making more measured and more disciplined decisions with your money. It does not mean that you need to deprive yourself of anything that's not a basic living need. It just means that you're being smart about what you're spending your money on. And if you're doing that really well, then when you do have something that comes up that you really want to splurge on, you're able to do that because you've been managing your money so well along the way. All right, so always focus on what are my needs versus what are my wants here. So as we talk about sound budgeting and all our goal in becoming good budgeters, good with our money, is to be one day well off. So let's get on the same page about what it means to be well off. I think if we all kind of closed our eyes and we had to think about, who are some people that are really, really well off, probably all of us would kind of come up with at least some people among those that were celebrities, right? They'd be athletes, they'd be musicians. And the reason why we think that way is because I think we think of people who are well off as people who have really high earnings. They have a really good income. And that is not always the case. Let me give you a couple examples. This gentleman here goes by the name of Nicolas Cage. You might recognize him. He's an actor. He earned between 1996 and like 2011 or something like that. He was one of the highest grossing actors, earned about $150 million. And in 2009 alone, earned $40 million. Now, in that very same year that he earned $40 million, the IRS hit him with a $6.2 million tax lien. A tax lien is basically when somebody does not pay their tax debt that they owe to the IRS. And do so for long enough that the IRS says, okay, we're going to lay legal claim to your property. And he later disclosed that he was $14 million in debt to the IRS. Some of the things that Cage spent his money on, he had 15 houses, including 2 European castles. He had an island in the Bahamas. He owned an entire island. A $450 million Lamborghini, some of my personal favorites, an $150,000 octopus, as well as a $300,000 dinosaur skull. And so as he went through all this financial difficulty, even though he had earned so much money, ultimately several of the properties that he owned had to be foreclosed upon, which basically means, we talked a little bit about last time, when you buy a property, a lot of times you're taking a mortgage, which means a lender is giving you you're borrowing some money from a lender. The lender basically took possession of those properties, kicked him out, and sold the property so that they can make back the money that they were owed. High income earner, not very well off, though, ultimately financially. Another example, this is Mike Tyson, heavyweight boxing champion, earned about $400 million during his 20-year boxing career. Mike Tyson in 2003, despite all those earnings, filed for bankruptcy. And he reported at that point being about $27 million in debt at that time. Some of the things he spent his money on was he had dozens of luxury cars. He had 4 Rolls Royces. He had a $7 million necklace. He had a 150-foot yacht. He had a few different Siberian tigers, which reportedly cost about 200 grand per year just to feed them. And one of my favorite items that he spent his money on was a $2 million bathtub for his first wife, who was an actress, Robin Givens. So, these are examples of people who earn a ton of money and we think of as really well off, but they didn't really understand the full equation to what I would say it means to be well off. Income is just part of the equation. The other important part of the equation is spending. And that is what those 2 examples, weren't controlling well. So in my eyes, being well off is about savings. It's the difference between the income we're bringing in and what we're spending our money on. What's left over is our savings, and that's what defines somebody who's well off. And what we are really going to focus on next time is, once we're doing that savings, we want to make sure that those savings are working for us. And by that, I mean investing and growing. But we'll focus more on that next week. So let me give you some examples of people who meet my definition of being well off, which is that they, manage both their income and their spending really well. This is an actress, Zooey Deschanel. She's probably best known right now for her work on the sitcom The New Girl. She got divorced in 2011, and that made her personal finances public. And when those became publicized, it became clear that she was really, really good at managing her finances. She at the time was making about $95,000 per month, and she was only spending about $22,000. And even though $22,000 is way more than the average person makes or spends, when you think about it relative to her income, that means that she was only spending less than a quarter of the income that she was earning every month, which is tremendous. They found that she had about $1 million of cash saved in the bank. She had another $2 million that was invested in stocks and bonds and growing for her. She had 0 credit card debt that she carried over from month to month. We talked about the importance of that last week. And she even was donating $1,500 a month to charity. So a really, really healthy budgeting from her. Another great example, Marshawn Lynch. He was a running back, spent a lot of time in Seattle. And during the course of his 9-year NFL career, he reportedly earned, I think it was about $54 million. And it is widely reported that he banked almost that entire NFL earnings, and he focused on living solely off of his endorsements from, Nike, Pepsi, Skittles, and so on. And that allowed him to be able to retire from the league on his own terms. And his sound money management has been such an inspiration to some of these other players that I want to read you a direct quote when the Giants recently drafted Saquon Barkley, their running back, in 2018. He told ESPN this. He said, "You know what? I kind of want to follow the Marshawn Lynch method. I don't want to touch that." He was referring to his NFL salary. "I want to invest it, put it in the right people's hands, and learn as I continue to make investments and just live off of endorsement deals." So Marshawn Lynch, I would credit with not just managing his own money well, but doing such a good job of it that he's become an inspiration to some of the younger guys that are coming into the league. All right, so now we're going to kind of sharpen our pencils and we're going to get down to it. We're going to talk about the nitty-gritty 50, 20, 30 strategy. And I really believe that if people grasp this strategy well, you're going to be pretty good with your personal finances. So before we kind of sit down to do any sort of budgeting, the important first step is to get organized. And regardless of what strategy we're following, the first step is to figure out what is our net income. Net basically means after taxes. So we focused a lot last week on, understanding that tax is going to reduce the amount of money that we're actually bringing home and hitting our bank account. And so we want to calculate what our current after-tax income is. And so I'm going to give you an example here. Some employee has a salary from their employer of $60,000. But after their taxes, after they contribute to retirement and health insurance and all that stuff, they get what hits their bank account is $1,500 or so per pay. And if they're paid biweekly, which is 26 times in a year, 1,500 times that's 26 times, means that hitting their bank account is about 40 grand every year. Now, for some of you guys that are working now and you might get a weekly paycheck, you can think of, what tends to hit my bank account on average every week after taxes. And you can multiply that by 4 or 5 to figure out your monthly amount, or by 52, which is how many weeks in the year, if you don't quite work every week in the year, whatever weeks you think appropriate. So you can figure out an annual figure of what's hitting the bank account. And then if you need to, divide that by 12 to figure out monthly what tends to hit the bank account. So doing that math is a really important first step to budgeting, how much you bring home after taxes. Then if you have any debt, we want to get organized there too. And you want to know the data on what are the interest rates on my debt? What are the balances I owe? What are the minimum payments that are required versus if you're making more than minimum payments, what am I paying right now? And how much time is left on these debt obligations? All right, so now we're organized and we're ready to embark on this 50, 20, 30 strategy. All right, so this strategy is based on our after-tax income, and the name, which is not very creative, comes from the following. It means that we want to spend 50% of our after-tax income on our essential needs. We want to spend 20% of our after-tax income going towards ensuring a comfortable future for ourselves. So what that means is like saving money and reducing our expenses. And we want to spend 30% on our lifestyle spending. These would be our wants and so on, okay? And so 50, 20, 30, I'm going to go into each one of these categories separately and focus on them, but this is kind of the main structure of it. What I love about this plan is that it is percentage based. And when we are thinking in terms of percentages of our income, that means that this can be applicable whether you are making $30,000 a year, whether you're making $60,000 a year, whether you're making $600,000 a year. If you are following these percentages, then you will always be, in theory, operating on a really responsible budget. All right, so what does this mean then? Let's kind of connect the dots between these percentages I'm talking about and what that means in dollar terms. So we want to take these percentages and we want to convert them into dollar terms so we know how much we can spend on each of these three important categories. So I'm going to go back to my example of before. Someone has a $60,000 salary, but after taxes and all these contributions, what's hitting their bank account is only $1,500 per paycheck. They're paid 26 times in a year. And so that's 40 grand a year, split monthly, about $3,300 a month. Okay, so these are the numbers, the $40,000 and the $3,300 that we're going to operate under for our income. So to figure out how much we can spend on each category, 50% is the same as the decimal 0.5. 0.5 times 40 grand, 20 grand a year should go towards our essential needs. 20%, 0.2 times 40 grand a year, 8 grand a year should go towards savings and reducing our expenses. 30%, 0.3 times 40,000, 12 grand a year, should go towards our wants, our lifestyle spending, okay? And split up into monthly terms, you can see it here, $1,600 on essentials, about $667 on saving for our future, and about 30% is $1,000 a month on lifestyle spending. Let me just, before I kind of get into each one of these categories and we spend some time on each one, let me pause here. Do you guys have any questions so far on what we've hit on? So far, so good? All righty.
Yeah.
Oh, yeah, go ahead.
Oh, I said so far, so good.
All right, so far, so good. Awesome.
Agreed.
So let's start with the essential spending category. This is where we want to direct 50% of our after-tax earnings. So what falls under this category? First and foremost, the cost of our shelter, the cost of our living, which would be mortgages. If you own a home, for those of you who weren't with us last week, a mortgage is basically when you buy a house, most of the time you're borrowing money from a lender to be able to make that large purchase, and then you're repaying the lender. So those repayments that you're making is called a mortgage. If you don't own a home, then you're probably paying rent for your apartment or your house. So those monthly costs would obviously be an essential expense. However, what we don't include would be home improvement costs. So if you want to remodel your kitchen, yes, that's going towards your living space, but that's not technically an essential spending need. Utilities, so we got to have heat, we got to have water and electricity and so on. What's not included is cable. And actually what we're not including here is phone because of what I mentioned before. There's such a wide discretion on what type of phone we have that we technically don't treat it as an essential expense here. Groceries. This is the food that we're buying, to stock our refrigerators. What does not count towards this is dining out. So if you're going out to Dinosaur Barbecue 5 days a week, that's not essential spending. That goes in our 30% lifestyle spending category. Finally, gas or transportation. So when it comes to this, think of the expenses for going to work. So if you drive to work, gas for your car. If you take a bus to work, bus pass. If you live in, say, New York City and you take the subway to work every day, it's your Metro card. But this is not our car loan payment. That's going to go in our lifestyle spending because, the difference, but yes, we need a car. I need a car, but the difference between a Range Rover payment and a payment on a 10-year-old Honda, very different. So technically, we treat the car loan payment as a 30% in the 30% lifestyle category. And also, vacation or leisure travel costs. If I want to go skiing in the Swiss Alps, yes, I need to take a plane for transportation to get there, but obviously that's not an essential spending. So this is more gas and transportation to get to work. So this is kind of a sub breakdown. It's more of an example, and I'm actually not going to go into a lot of detail on this because I have a lot I want to hit on today, and I want to make sure we get to all of it. But I mainly wanted to show you this slide because a lot of people, they really wonder when it comes to buying their first house or buying their next house or looking at apartments, they wonder how much should I be spending on it? And the mortgage or the rent payment tends to make up the vast majority of this essential spending category. And it's a basic rule of thumb that you don't want to spend more than a third of your income on your rent or on your mortgage. So as you guys are, looking for those things for your first time as you start your careers, try to kind of keep that rule of thumb in mind that you want to spend less than 1/3 of your after-tax income every month on your mortgage or on your rent payment. And if you can keep that even lower, like 25% or 20%, that's ideal, but you want to keep it, under 1/3. You know what, I'll go back to this for a second. So what that means in dollar terms, again, when we were figuring out, okay, 50% of our income every month, we want to go towards essential spending. If 30% is going towards rent or a home payment, that means that basically we want to be spending $1,000 a month on rent or $1,000 a month on our mortgage. I'll mention too, I forgot to mention this before, that, when you're doing this sort of planning, if you are a single income household, then you're obviously doing these percentages based off of you. But if you're a dual income household, like my wife works too, so we're a dual income household, you can combine your incomes and do these percentages and calculations off of all income that's coming into the household. So I'm gonna move along away from the essential spending category, and we're gonna focus on that second category, the 20% that should go towards ensuring a comfortable future for ourselves. Okay, so we want to spend 20% of our income every month or every year going towards this category. So what falls into this category? One, saving for retirement. We want to build up a nest egg one day of savings so that we can stop working when we want to, but when we stop working, we're able to replenish the income that we need to support our lifestyle that we've grown accustomed to. And that takes years of saving and planning. Two, we want to reduce and eliminate our personal debt. And three, we want to establish an emergency fund. I'll talk more about that, but these are the 3 items that we want to dedicate our 20% of income every month towards. All right, so we're going to take each one of those 3 things separately. First, saving for retirement. I'm going to talk more about retirement plans in next week's presentation because there's a lot of really beneficial details to get into on that. However, we want to utilize these plans, these retirement plans. They have a lot of benefits. One, if you're saving through your employer's retirement plan, which you guys may have heard of these terms like 401k or 403b, that's an employer affiliated retirement account. And when you participate in those things, your contributions are automatic once you set them up. And so it forces you to do the savings and you kind of forget about it in a good way. You adjust to it. So that's a really positive thing to be able to automate that savings. Also, retirement accounts, whether we're talking about 401ks, Roth IRAs, there's lots of different types of them. They all have tax benefits, which because of those tax benefits are going to help our money accumulate better over the years. And finally, inside of these accounts, we're going to be able to invest the savings. And let me show you kind of an example of how beneficial that can be. Let's say that I save $400 a month over 20 years, but I just throw it into a savings account at my bank and it gets me 1% interest every year. Well, at the end of 20 years, I'm going to have about $106,000. However, Joe puts in $400 a month for 20 years, but he invested the money and he earned an average growth rate of about 6% from those investments. We saved the same amount of money for the same amount of time, but because he invested and got a better growth rate over time, he ended up with $185,000, almost $186,000. So saving money is a big part of what it means to be well off and to manage our finances well. But taking that extra step and investing some of those savings is also going to make a huge, huge difference over time. And we're going to focus more on that next week. So another thing that we need this 20% of our income to go towards is reducing or eliminating our debt. And so, types of debt that we place into this category that we're trying to get rid of or strategize to get rid of would be credit card debt, student loan debt, and personal loans. This would kind of be loans that you took just because, you were buying a boat or something like that or whatever, personal loan. What we don't include in this category is mortgage debt or car loans because those technically go into different categories of this strategy. So mortgage debt, that's essential spending. That goes in our 50% category. And car loans, that goes in our lifestyle spending. So we don't technically put those into this category here. Now, if you find yourself with some of these debt payments, we talked about last time, we want to avoid credit card debt, but so many people find themselves with some of it. So we want to be prepared to tackle it if you're in that situation. You might have student loans. So many young people do. So if you have some debt, I want to go over quickly, some of the strategies to tackle this. There's two strategies. One is what I think is best financially. And this is where being organized is so important, because if you have all those details together that we talked about before, the interest, the required payments, the balances, you're going to be able to tackle this really strategically. So I'll give you an example. What I think is the best strategy to tackle debt is to basically organize your debts from the highest interest down to the lowest interest. Now, remember, interest is what you're paying to a lender that you borrowed the money from, and so that's going away to them. So the more interest you pay, the more costly it is. So what we want to do in this strategy is we want to make the minimum payment allowed on every item except for what is number one on our list, which would be the one with the highest interest. And on that item, we want to pay as aggressively as possible on it. And then when that's done, we move on to the next thing. We're making the minimum payment on everything except what's number one on our list, the highest interest, and we're paying most aggressively on that, then moving on to the next thing. And so what this is going to do over time is it's going to tackle our highest interest debt first, and therefore save us the greatest amount of interest payments over the lifetime of all this debt. So even though in my examples here, we're not focusing on the largest debt first, and that seems a little bit weird, I do feel like this is going to be best financially because we're saving so much interest over time. However, there is another debt reduction strategy that's kind of best from a psychological standpoint. And this is really beneficial when people are in a lot of debt and they just feel this weight and it's overwhelming them. Sometimes you just need something to feel like, you're heading in the right direction, and this strategy can work well there. This is where you have the same debts, as you'll see from my examples, but you just organize it differently. So you organize it from your lowest balance of outstanding debt to your highest. And that allows you to be able to tackle your lowest balance first. Okay, and what this is going to enable is that you get rid of debt faster. You get rid of each item faster. So the payments that you're making on your home equity loan, once it's done, you can then roll that into what you're making on the second thing. So you're making, like I mentioned last time, the minimum payment on everything except what's number one on the list. You're hitting that aggressively, and then you're moving on to the next thing. You're going to be paying more in interest with this strategy than the first strategy, but it's going to help you tick through paying off the items a little bit quicker. All right, and the last within the of the 20% that's going towards ensuring a comfortable future for ourselves is building an emergency fund. What is an emergency fund? It's kind of like what it sounds. It's kind of a slush fund of cash that should be kept in a really accessible and really safe place, like a bank account, that we can access quickly. Because things come up in life. We're going to have things that break with our car. We're going to have repairs that need to be made at our houses, loved ones that get sick and get married, and we need to, buy a plane ticket with short notice. These things come up, and if you don't have any sort of slush fund that you can dip into to meet these unforeseen expenses, we tend to put it on credit cards, which can get us into debt that's really tough to get out of. So we need to have some fund that we can take from. So an emergency fund should be kept at a place like a bank account or a savings account, not invested, because investments can fluctuate in value. And if your investments are down at when you need that money, that's not good. So it's not money that's invested, and it's not money that's locked into anything for a period of time, just traditional bank account. How much you should keep there? Probably between about 3 to 6 months worth of your annual expenses. So if your annual expenses, you calculate to be around 30 grand a year, 3 months would be about 7,500, 6 months would be about 15 grand. And the way that you discern whether you need to have 3 months worth of your annual expenses or 6 months is whether you're a 1-income household or a 2-income household. So if you're single, you want to have probably 6 months cushion in an emergency fund. Whereas if you are a dual income household, 3 months is probably fine. So I mentioned My wife and I both work. We're probably fine with a 3-month cushion because if my wife lost her job, well, we still have my income to float us. If a single person were to lose their job, they're going to want a more comfortable cushion in case it takes them a little time to get their paycheck again. All right, so just to review this category, 3 main items: saving for retirement, reducing our debt, and establishing an emergency fund bank account. All right, this is where our 20% of our income should go towards these three things. But if you think about it, as time goes on, you're going to be able to check a couple of these things off the list. So once you build your emergency fund, it's built. You can then take that money and put it towards saving for retirement and reducing your debt. Once you pay off your debt, it's done. And so that money can then go towards saving for retirement. So initially, you might not be able to put all 20% towards saving for retirement. You might do 10% towards retirement, 5% to debt payments, 5% towards building an emergency fund. But as time goes on, in theory, we should try to strive to be saving 20% fully towards retirement as we take care of those other items. Until that point, it is a little bit of a balancing act. The 20% needs to be split between all these important things. All right, so I want to get to the last category, but I know that section was a little bit technical, and that's a really important section. So let me pause again. Do you guys have any questions right now?
No, it's making sense.
All right, awesome. Love to hear that. So the last category, finally, this is the fun stuff. 30% of our after-tax income can go towards our lifestyle spending. There's a lot that can fall into this category, but some of the common ones, maybe these two aren't as obvious, but car loan payments, cable and phone, going out to dinner, pets, home improvements, gym memberships, daycare, the list goes on and on and on. These don't fall under essential needs necessarily, although you can make the argument for some things like daycare. But they are things that we either have a wide discretion over what we spend on the items, or they're just totally kind of luxury expenses for us. And if you really understand this strategy well, you can use it to make financial decisions, not just assess, is my budget good, which is kind of how I look at it. Every once in a while, I'll kind of look at my expenses and I say, am I saving 20%? Am I keeping my essential spending or am I keeping my lifestyle spending to 30% or less? But not just to assess it, but you can make decisions. So if you say, okay, 30% of my after-tax income every month should go towards lifestyle spending. That means, from my example of somebody who earns about $3,000 after taxes every month, 30% would be $1,000 a month going towards their lifestyle spending. So if they take an inventory of the expenses that they have in this category, and they say, I spent $250 on cable and phone, $150 on going to eat, $100 on my pets, $50 on my memberships, $200 on just other stuff, clothes and this and that comes up in the month. That leaves me with $250 left over every month. In theory, you should be able to make a $250 car payment, and that should help you figure out, what cars you can look at, how much you might need to put down in order to arrive at a $250 payment. Really make decisions if you understand this strategy well too. All right, so that is the 50, 20, 30 strategy. One point I want to make, I've already made it, but it's something I want to say again and again. Automate as much as you can, especially to that 20% category where we're saving money or we're spending down debt. Try to set those things to happen automatically to force yourself to do it. If you're building an emergency fund, automatically sweep money every month from your checkings to your savings account. Automatically contribute to your retirement accounts. Automatically make minimum payments or extra payments on the debt payments. If we leave these things to our own discretion, oftentimes we forget a month or we don't do as much as we really should. All right, so I want to tell you guys, I made the point earlier that sometimes human nature gets in the way of good budgeting. And I think one of the most common things that can lead to people overextending themselves financially is a feeling like they need to keep up with the other people around them. The term that's common for this is called keeping up with the Joneses. You know, we see what our neighbors are buying, we see what our friends are buying, and we feel like, you know, we need to keep up with that. And if you can resist that self-consciousness to feel like you need to measure yourself based on everyone else and you can just make sound decisions for yourself, it's going to go a long way. So I want to give you guys a couple of examples of people who I think are pretty inspirational that, you know, we can kind of strive to be like there. This house here is in Omaha, Nebraska, and a guy bought it in 1958, I think. 1958, he bought it for $31,000. He's never bought another house. He only owns one house, and he's never moved from this house since 1958. Anyone know who this guy is? This old guy is Warren Buffett, and he's worth $87 billion. He's the fourth richest man in the world, and his net worth is larger than many, many, many countries' entire economies. He has owned one house that he spent $31,000 on his whole life. We talked about Nicolas Cage, who was worth, even at his peak earnings, a fraction of Buffett and had 15 houses. This is a guy who doesn't care what other people think, whether he should have multiple houses or mansions. He can afford to spend more money, but he knows what he's comfortable with in his lifestyle, and he just spends accordingly. Now, he's also not someone who deprives himself of things that he wants. He's famous for kind of saying his one major splurge is he owns a private jet. Anybody who owns a private jet is not depriving themselves, but he does it because he's a big businessman. He needs to be able to get places, quickly that are very, very far away. And so he says, he doesn't own a zillion houses, but he does spend a lot of money on something that's really expensive but important to him in another area of his life. So I thought, that's a really inspirational person to obviously strive to be like with personal finances. This car here, this is a 1997 Chevy Tahoe. It was not taken in 1997. It was taken very recently. It was driven by Kawhi Leonard, who at the time he was driving it was in the midst of a 5-year deal for about $94 million with the Spurs. And it was Sports Illustrated. I have the quote right here. Sports Illustrated asked him, basically, why do you drive this car? You're making a ton of money. And he just simply says, it runs and it's paid off. Again, another, I thought, inspirational example of a guy that doesn't care that he has the means to drive a totally different car, doesn't care that the guys around him are probably driving much nicer cars, comfortable in his own skin, and it allows him to spend money on things that maybe are more important to him. So those are positive influences. I want to give you guys a few stats that to me are a little bit scary, just so that you guys also understand the importance of being good budgeters, because very few people actually succeed at good financial management. We've talked about Marshawn Lynch, we've talked about Kawhi Leonard, two great examples of athletes that manage their money well. This stat to me is striking. 78% of NFL players go bankrupt or under financial stress within 2 years of retiring. 60% of NBA players go broke within 5 years of leaving the sport. Really, really sad. Now, athletes get a bad rap. I tend to feel like if everybody had the financial cash flow that they did, they would also run into problems. But still, these numbers are pretty striking. Let's talk not about people who make above average incomes, just the everyday American. In 2018, the US Federal Reserve did a study that found that 40% of American adults wouldn't be able to cover a $400 emergency with cash savings or a credit card charge that they could quickly pay off. So a $400 unexpected expense would throw 40% of people off in this country. Also, I think speaks to the fact that they don't have emergency funds like we talked about. And people's budgets are really on a knife's edge. My last topic, I want to make sure we leave comfortable time for questions here. It's shifting gears a little bit, but so much of what we talked about, you probably get it from a logistical standpoint, but what we're not mentioning is that it relies upon having a bank account. And some people, if we just can't kind of keep our money in hard cash, you can't accomplish some of what we've talked about to the strategies. So the advantages of a bank account is, one, they're safe. there's something called FDIC insurance, which is the federal government essentially insuring up to $250,000 of the deposits that we make in a bank. So if the bank fails, up to $200,000 will be reimbursed to us. So saving money into a bank is a safe place to put money. Whereas if we save it in our dresser drawer, I know if I did that growing up, my little brother would definitely steal it. So it's a safe place. Earning interest on deposits. In this environment, interest rates are pretty low. We're not being compensated very heavily. But in a more normal environment, you're earning some interest on the money that's sitting in a bank account as opposed to the dresser drawer where it's not earning anything. It allows us to automate our savings. So when I'm saying, okay, let's set up an automatic $100 a month into this retirement account, $100 a month into this savings account, you can't do that unless you have some bank account where it's coming from. We can't automate our cash payments to our debt or to our investment accounts. Better record keeping. It's going to allow us to look back months and years and say, what was that check that I wrote? And you pull up an image of that check, pull up a ledger of exactly what our spending was. So it allows us to go back and keep track and confirm, did somebody actually cash that check or not? Which we can't do when we're just operating in cash. And finally, it's less expensive than a lot of alternatives. If you don't have a bank account and you're taking your check at the end of every payday and taking it to a check cashing company, they're going to charge you a lot of money to do that. So having a bank account, cashing the check that you make from your employer is free. These days, it really happens direct deposit. But if you ever do get a physical check, it's free to just put it into your bank account. So, I'm a big advocate of opening a bank account and utilizing them to kind of implement the strategies that we talked about. So I know that was a lot, guys, and that I went quickly with that, but this is just such an important topic that I didn't want to cut out anything that was really vital to it. So I'm going to wrap it up there, and I just want to leave the rest of the time for questions.
I have